Hello and welcome to today's daily education here at Forex Academy. I am your host, Robert Blackwell, and have the pleasure to walk you through today's daily education. Now, before we do so, please consult the following disclaimer. There is risk inherent trading the financial markets. On the content of today's particular webinar, we will be discussing volatile markets. Now, it's worth noting, just as I go through today's education, that different asset classes, different markets, of course, experience different heightened levels of volatility. And again, some markets at times experience low volatility, whilst when certain new information comes into the market, of course, can experience higher levels of volatility. So we'll start off with defining volatility. Again, a security that is regarded to have a higher degree of risk will trade with a higher level of fear and uncertainty to price action changes. So it's all about price action changes, the movement of price. We can visibly see this volatility when market prices fluctuate more frequently and price action trades in a more rapid manner. Okay, a more frequent and rapid manner. More extreme changes in the market's trading range present us with a physical representation of this volatility. So if you're looking for volatility in the markets, perhaps you like to scalp and trade with small trade size due to volatility. You're looking for extensive moves in price action, rapid, extensive price action moves. We thus assess volatility by analyzing the price action. In general, a market that trades 100 pips per day on average is much more volatile than a market that trades 40 pips per day on average, okay? That leads us on to discuss the average true range. Technical traders attempt to explain the volatility of a security by observing the market's average true range, or the ATR. So the ATR for one market, of course, if you're looking, let's say we look at the daily candlestick over a 14-day period, averaged out across that 14-day period, of course, for the range of the German DAX, and it trades 70 pips of an average ATR, okay? Whereas the FTSE in the UK the FTSE 100 may trade 100 pips, okay, over that 14-day period. Of course, which market is more volatile? The FTSE 100 over this 14-day period. Now let's look at volatility in a bit more detail. This is the S&P 500. And again, this is one particular market, but you can see volatility changes when new information comes to light. Okay, so here we have a very constructive trend to the upside. The trend experiences less volatility and less retracement, i.e. less movement of price. So it's more of a constructive trend. Again, you can see the size of the candlesticks, guys, are much, much smaller than these heightened levels of volatility. That changes, and then we see a very structured move to the downside, okay? And as you can see, because of this huge amount of volatility, this was a market correction there of February 2018. We can see now that there's a heightened level of volatility in this particular equity asset, okay? And that is going to change the landscape of trading this over the next, I suppose, 3 to 4 months until that volatility starts to decrease. So we can see, has the long-term volatility increased? In the short term, it has, certainly for 3 to 4 months. We can now see, guys, with more relative price action now, the volatility has actually come out of the market a little and is starting to trade a little more conservatively in terms of its price action ATR range. Now, that's just one example. Of course, we can look at other markets. Are there different periods of volatility in this market, and how does this affect our notion of risk? The answer is, of course, yes. So here to the left-hand side, we can see the market's trading just with a little area of price consolidation, just drifting up. Okay, we can see it's just drifting up with lower lows. Then that changes, and again, as these levels break, we see heightened volatility. Look at some of the candlesticks there, giving us the signal that there's more volatility in the market. Again, that it dissipates and comes out of the market for a while until we get another trend to the upside. Again, that volatility again relaxes until we get more of a structured trend, until there is a break of this level here. I suppose the long-term highs in around 120 of this level. This is the Euro Swiss franc, commonly known, of course. The 120 is a significant level here. That doesn't breach, and of course we get a lot of volatility to the downside. So something has changed in this market. We see perhaps it's news flow, perhaps it's technically breaking to the downside. Again, volatility has increased, and again, that should change our level of assumption of risk when trading. Here's another market here in the short term. We have the euro pound. Now, is this different? How would we like to approach this? Is this market more volatile than perhaps other forex markets? What do we think, guys? in this current time period that we are observing here, this price action chart, the answer is yes. You can clearly see that. And there's two ways to identify this volatility. Number one, we have, of course, the movement, the fluctuation of price. We see green candles, red candles. We see very, very large green candles, then immediate retracements in a 1 or 2 day period of those red candles. So effectively, if I draw an average price over this this price chart again, guys, we're really trading in around this price for such a long period of time, okay, 87.50. However, look at the amount of volatility from high to low. Again, it's constant, it's moving, it is showing some serious fluctuation in price, and again, it's very uncertain. Okay, so there is that level of fear and uncertainty that causes the volatility. Now, the second way we can clearly see this just by observing the price action is, of course, the structure of the Japanese candlesticks themselves. We're looking to define the ATR. We're looking to define the average true range of some of these candlesticks. Again, even though, guys, we have potentially a trading range of around from 88.25 to 86.82, not a huge range in terms of its overall price levels, okay? However, the volatility in some of these candlesticks are almost, 3/4 of the entire range there, you can see. So the actual candlestick structure here, we can see the volatility from high to low as they retrace or as they close with large bodies, very large bodies as well. We can see, guys, that we have some real pointers out that there's volatility in the short term in this market from a day-to-day perspective, and perhaps we should be trading this with less trade size, with less notional trade size, of course, and positioning ourselves correctly in trying to adhere to that volatility. So again, one of the main points just I'd like to make when trading on volatility, always take into account the average true range, the ATR, the average true range of the current market environment. It will help you assess the likelihood of price fluctuation and help you assess what type of risk to assume in a trade. So that brings us to the end of today's daily education discussing market volatility. Thank you very much for joining us here at Forex Academy. We'll see you next time. Bye for now.